That's looking a bit more hopeful now, Councillor Shot. That should
Okay,
be a recording now.
we'll just wait for Gail to join.
No problem. He's apparently joining from America. He's in America for Thanksgiving and it's 5 in the morning there.
Crikey.
That shouldn't make any difference to our recording.
Is that Gail back then?
Yes.
Okay, so we'll just kick off. Do we have any apologies?
No, I haven't had any submitted.
Okay, any declarations of interest or transparency statements? None. Item 1 of the agenda is the minutes of the last meeting. Are we okay to agree the minutes? Okay. Item 2 in the agenda is the Common Goods Fund's 6-month report to 30th of September. David will kick us off.
Yeah, thanks, Councillor Shaw. Let me just share a few slides. Yeah, thanks. Hopefully you can all see that now, and morning all.
Yep.
I'll run through the sort of usual format of a presentation here in terms of starting with a bit of market background over the last 6 months to the end of September. Essentially giving a high-level summary of how investment markets performed over that period, which will then hopefully be helpful in setting the context for the investment performance of the Renfrewshire and Paisley Common Good funds over that period, and in your discussions with Gail later in the meeting. I think starting with the market background over the last 6 months to end of September on slide 2, and please do ask any questions as I sort of go through these slides. Maybe take a minute just at the start to kind of talk through what's on this slide, because I've got a sort of busy chart with a busy slide with a lot of charts and text on it. The chart at the top here is essentially giving those market level returns over that 6-month period. The first 7 columns cover equity markets, so everything from global to emerging markets are the returns of those regional equity or stock markets over that period in sterling terms. The yellow columns are perhaps the most relevant to the discussion here in terms of showing the returns for that past 6-month period. The light grey and the sort of darker grey bars also give some helpful context in terms of showing longer term returns over a 1 year and an annualised 3-year period. Further along in the charts, we have the returns of bond markets, so UK gilts or government bonds, then corporate bonds, overseas government bonds, and finally the sort of last 2 showing the returns of property markets and what you'd have earned just sort of sitting in cash over those periods. On the bottom left here, we have a chart showing annual inflation levels over the past few years for the US, Eurozone, and perhaps the most relevant one here, the sort of yellow line showing UK inflation. Then finally, the chart on the bottom right shows sort of currency moves over the past 6 months for the pound versus some major global currencies in terms of the euro, Japanese yen, and US dollar. I think from those numbers at the top of the chart, it's fair to say they mask a lot of underlying volatility in markets. It's been a very volatile period since the end of March, if you can sort of think that far back, went back to the sort of Trump tariffs in early April, or the sort of trade deal negotiations that followed that. I mean, even more recently as well with the sort of focus on UK budgets. It has been a sort of volatile period, so although you can see in those bars, and particularly the yellow, showing very strong equity market performance over that period, it's not been a straight line upwards over that 6 months. Taking a step back from all of this, I says that chart shows equity markets performed strongly over that 6-month period, albeit we know there's been a lot to look at under the bonnet, and then the sort of performance of bond markets, whether it's UK government bonds, corporate bonds, overseas bonds, has been a bit more mixed. The economic backdrop to all of this, supporting those sort of equity returns over that period, despite the increase in tariffs in early April, global growth had remained sort of fairly resistant in that first half of the year and allayed any fears of a sharper economic slowdown. That said, growth is set to slow modestly in the second half of the year if those tariff effects deepen. Consensus forecasts put global growth at 2.4% in both this year and next year, down from earlier projections and below last year's 2.7%. However, it feels like that sort of deeper economic slowdown is unlikely given some of the ongoing reasons stated for that are the sort of ongoing US AI investment, sort of delayed effects of rate cuts from central banks coming through, and moderately supportive fiscal policy both in the US and Europe, and also sort of strong corporate and household balance sheets continuing to support growth and, as I say, perhaps allaying any fears of a deeper slowdown. That said, on the inflation front, inflation continues to be above target in both the UK and US. So the inflation print today coming out in the UK, and that inflation is driven by persistent domestic pressures and the effects of those rising tariffs, respectively, for the UK and US markets. And the inflation in the UK and US is expected to stay above target until at least 2027. In the UK, we've seen elevated wage and services inflation combined with weak productivity, and those are posing challenges to inflation getting towards that Bank of England 2% goal. In the US, it's more that sort of tariff-related price pressures are likely continue to build as importers deplete their inventories and pass on those costs to consumers. That said, I think on the inflation front, I mean, we're nowhere near, you can see the sort of chart at the bottom left here, we're nowhere near those inflation levels that we were in sort of September 3 years ago. Putting some numbers to the comments on equity markets, perhaps move on to the next slide here. Again, we've got sort of gilt yields, the move over that 6-month period to end of September on the top left. I've seen a bit more volatility recently in terms of that, looking ahead to that UK budget. Showing credit spreads on the chart on the top right and the moves over the last few years. And then sort of diving a bit deeper into those equity market returns, showing returns of both regional equities and still in local currency terms on the bottom left, and returns of the different sectors within the global equity markets on the bottom right. So on the global equity front, global equities gained 15.4% in sterling terms over that 6-month period as market sentiment dramatically improved after April. So tariff announcements alongside strong corporate earnings and AI enthusiasm in the markets. That AI enthusiasm particularly boosted the performance of the tech sector, with over 30% returns in sterling terms over the 6 months. UK stocks, however, did sort of underperform, just given their sort of low tech exposure and above average exposure to some of the poorer sector performers. You can see this in the chart on the bottom right here in terms of some of the underperforming sectors were consumer staples, energy, healthcare, which are more prevalent in sort of UK market. I think the key question then is how, given that market background and performance, how does that impact your portfolio? On the next slide, I'll focus on the Paisley Common Good Fund here, though comments equally applied to the Renfrew Common Good Fund. Over the past 6 months, the portfolio was up 10% over the period, in line with the strong equity market performance, though did marginally underperform the fund's benchmark by around 0.3% over that period. Over the past year, the portfolio is up 7.5%, though there is a more material underperformance versus that benchmark of 5% coming through, but that can sort of largely be traced back to the underperformance in Q1 of 2025 that you can see there. I think that says the longer term performance, so since inception, for these purposes is deemed to be sort of middle of 2015, on an annualised basis, the performance of Common Good Fund has been just shy of 7%, which is pretty much exactly in line with the fund's benchmark. Turning to portfolio positioning, the portfolio continues to sort of slightly less in bonds than the 18% weight, and the percentage of bonds is held has reduced slightly since the end of March. Now, the context of previous slides is probably helpful here, as the value in bonds hasn't reduced, but because equity markets have been up 10 to 15% or so, but bond performance has been pretty flat, and those sort of natural drift or natural adjustment in those weightings is probably what you're seeing here coming through. That said, there has been some changes within the bond portfolio, as the proportion held in sterling corporate bonds is reduced to 0, with a resultant increase in the international bond positions. Gair has explained that this is driven by a change in funds held within the portfolio, and although the funds now held are categorised as global corporate bond funds, the underlying holdings will include a lot of sort of UK corporate bonds, so the change perhaps is not as stark as it looks on the slides here. The portfolio also continues to retain its underweight to UK equities and overweighting global equities relative to the benchmark weightings. This will have benefited performance over the 6 months, given global equities outperformed UK, and has been beneficial over the longer term. I think the last note for me is just around the estimated annual income for the two common good funds. Continue to be well above their respective targets at almost 155,000 versus 129,000 on the Paisley Common Good Fund, and there's over £100,000 of headroom on the Renfrew Common Good Fund versus that 492,000 target. Happy to take any questions on either sort of market background or performance position on portfolios, otherwise sort of pass on to Gair from LGT to go into further detail.
Thanks, David. There was a lot of chat recently about the a potential AI bubble, and some big investors appear to be selling Nvidia at the moment, which was one of our stocks. We've got a small share in there. How do you manage something like that? And, how do you plan for potential catastrophic events in terms of something like a bubble?
Yeah, I mean, I'm sure Gair can maybe go a bit more in detail in terms of the Nvidia position, and perhaps taking a sort of longer term view on how that's performed within the portfolio versus maybe some of the shorter term volatility that we're seeing in markets just now. Yeah, I think it is just that sort of longer term outlook that's needed, and ensuring part of the risk reward from investment is taking those risks to eke out those returns, and then ensuring that sort of portfolios are well diversified in the risk that they're taking, and they're not too sort of concentrated within specific areas, like you say, sort of the AI bubble. I think the AI bubble is obviously very topical and interesting just now. Parallels drawn to the sort of .com bubble. Obviously, yeah, it's hard to say either way with certainty on where it's going to go without that sort of crystal ball. And yeah, I'm sure if we all had that, we might not be sitting here today. But I think the sort of two-sided argument on it is obviously the sort of AI companies and related are pouring in sort of astronomical amounts of money and investment being made by them. Almost, I think one of the terms seen trying to sort of build moats around and make it difficult for other firms to come in and essentially replicate what they do, given the amount of investment that's needed. So I think that's one support for that, and in terms of the valuations that they're seeing, in terms of that competitive advantage that they may have. And there's been sort of strong earnings. I think that's the question on, can they continue to sustainably grow earnings, albeit there's that strong investment being made. yeah, I don't know if maybe Gair has a
You can get Gair's
better view
view
in
on it as
terms of.
well.
It's it's an interesting one. I mean, I've seen I was presenting with one of my colleagues recently, and he was saying about, I hadn't heard it before, he was saying about how economists have predicted 8 of the last 3 bubbles. You know, it's one of these things. What do you do? There's lots of speculation and fear out there quite frequently about bubble territory. Not to say that things aren't really quite frothy, and as David's mentioned, the amount of money being spent, will they ever generate sufficient revenue to justify that expenditure? It has become a total arms race, and as we've seen in the past, you know, there'll be probably a few winners. Some will bumble along, and some might cease to exist. And who those are, we don't really know. We won't know until benefit of hindsight. What we do though is, and there are 2 things actually. So if I feel far more nervous about if somebody's saying we want to invest for the first time, we put new money into the market, we haven't invested before, I'd be so nervous about that. But if you've been in the market for so many years, such as yourselves, and you've benefited so much of the upside, that even if even if the companies drop by 10 or 20%, so 20% is considered a correction. And if that was to be the case, sorry, bear market, 10% correction, 20% bear market. But if that were to be the case, you'd still be up. You'd still be in the money by a comfortable margin. And so I feel much more comfortable on that basis. The other thing as well is that if any company in the portfolio goes up or down 20% within a 3-month period, then our analysts get together and do what's called a bull-bear analysis. So bull being bullish, taking a positive view, bearish being taking a negative view, and they get different analysts to basically almost antagonize the data to find out, right, what's the positive, what's the negative. Let's come and just look at this again and really sort of tear that apart and refresh it. So we're not just sitting there going, this is great, it's going up, and let's just hope that it continues to do so. If things move, and actually because of the sort of the magnitude of the changes and the moves, then they have been doing that. So at present, we're still quite comfortable, but it is something we're looking at, and very mindful that we've done well. I have been tending to top slice, so things like ASML, that manufactures the chips, TSMC and Microsoft are probably the 3 which are the really quite large holdings in the portfolio. And so every so often I'm just going through and just going, okay, because it performs so well, the weighting in the portfolio has increased. I'm going to top slice that. I'm going to put it into something else just to and intentionally get it away from artificial intelligence. So I'm trying to be as prudent as I can while still having substantial holdings in it to capitalize on the positive momentum. Councillor Shaw, does that give you enough?
Yeah, that's really interesting. It's also really interesting. We talked about the .com bubble, and I suppose we've got the survivors of the .com bubble performing really successfully for us now. So it's all cyclical, but the chat seems to be getting louder and louder and louder recently, and it was out of interest, obviously, with our interest in it. So, anyone else get any questions, comments? Nope. Gail, do you want to?
Sure. I will share my slides. And as is tradition, with David's macroeconomic update, I will skip past some of this stuff, just picking out a couple of points. Can you see the slides okay? Yeah, great.
Yep.
Okay, thank you. So skip past that. Actually, need to minimize you guys so I can see it myself. Yeah, so this is really just looking at the impact that currency has had as well, because albeit usually the dollar has been quite strong, and so if we're holding US assets, so let's say you're holding Microsoft, trades in US dollars, but we're holding it in sterling, then each time it goes up, because the dollar's been stronger, you're getting more pounds for each dollar earned. So it's been a positive tailwind. However, that's not been the case for the last wee while. Might be changing now, but it's for probably over the last 18 months or so, the dollar has been weaker against sterling. And so what you see here is the light blue line shows that if you're holding the US market and you're a US investor, you'd have made 10% at this point in time. However, if you're holding it as a sterling investor, you'd only have made 0.6%. And if you're holding it as a euro investor, you'd actually have lost money still. So currency has really been quite a big influencer over the course of this last year to 18 months. The other thing is, and I'll skip through these, as I say, quite quickly because David's covered so much in the macro already. So talk about the tariffs, how much influence are the tariffs actually having? Well, the top chart just shows the tax revenue from tariffs. And you can see that massive spike on the right-hand side. So yes, tariffs are having an impact. Doesn't really seem to have washed through, particularly into the economy, the general economy at present. And the bottom part just shows the US inflation. So it's not really picked up that much. I haven't actually checked this month to see what they're coming out at, because one of the concerns is that with the government shutdown, how much you can rely on the data at present, the statisticians, and also with the some of the Bureau of Labour statistics, with Trump having sacked the chief of that. There's been so much turbulence on the statistical side. So I think it'll be interesting over perhaps a more medium-term view rather than just looking in the short term, as perhaps does tend to happen normally. And what this slide shows then is how much the market expects rate reductions by, or how many rate reductions they expect the Fed to put in place. And so the number of rate reductions reducing, because still recognize that inflation is an issue, but also recognizing that economic slowdown is a real issue as well. And so having to try and balance that fine balance, which is what we're kind of seeing here as well. And I think obviously next week we have the budget in the UK. There'll be an interesting point, because everyone's kind of wondering what's going to come out of the budget. There's positive sentiment about, actually, are they just going to grasp the nettle, increase taxes, and get the domestic economy or the budget back on track? And so that really supported government debt, UK government debt, or gilts as it's known. But then when they seem to renege on that and feeling that perhaps they won't increase taxes, they won't have that headroom that we're expecting, then that could be quite negative. And it's been quite negative for government bonds, of which there's about 7.5% in the portfolio, which you can see up here on the right-hand side. It's about 7.5% in UK government bonds. So they've actually been more volatile than we'd normally expect, partly because of uncertainty over the UK domestic budget. Other things here, so I'll just mention on the top left. So here's the portfolio value. So for Renfrew here and Paisley here, if you can see my cursor, top left-hand side. So this was at the end of October. And just because I know we're looking at 6-month periods, David mentioned the portfolio being up 10%. That was actually to the end of September. If we look at the end of October, so it was up 10% at the end of September. End of October, they were both up 15%. So really strong returns, doing very, very well. So one of the things is that the way we invest, looking at these quality companies, as a reminder, David mentioned about how there's a low allocation to the UK. As a reminder, we just look for the best companies anywhere in the world, and the geographical distribution of the portfolio is an output of those companies we like, not a starting point. And the other thing, I had another point I was going to mention. What was that other point? Oh yes, sorry. Because of our quality approach, what we tend to find is that over the long term, we outperform. But within that, there will be periods, if a certain sector rallies strongly, then we may underperform a bit, because we're looking at quality companies which will just provide good returns year after year, or compounded over the long term. And so we may not shoot the lights out when there's a particular topic that's in favour, but also we tend to protect more of the capital if there are weaker markets, and that's exactly what we aim to try and do. It's worked very well for the 25 years, or best part of 25 years, been doing that, and it has been through global financial crisis, COVID, and all the rest of it, and generally done very well. The other weak period we've had in recent years was 2022. That was when Russia invaded Ukraine, and there's uncertainty over wheat and gas and oil supplies, and pushed up prices. And there's also the point at which the Western world came out of COVID restrictions. People moved back into the economic environment, wanted to buy goods and services, but China in the East was still adopting a zero tolerance approach to COVID. And so there's a disparity between supply from the East, demand in the West, and that became very inflationary. And so that was another period when we underperformed there, but generally either side of that performed very well. Anything I want to mention here, I mean, yeah, you can see the portfolios over 1 year, pretty much in line with both UK inflation plus 3.5%. I tend to focus quite a lot on these two here. So I may have mentioned this before, and forgive me if I have, but I've never met a charity I've never met a charity yet where their commitments bear any resemblance to the markets, got FTSE All Share or whatever. You know, it goes up and down, but charity commitments tend to be much more stable. And so I think most charities that want to be around for the long term want the value in the portfolio to increase at least in line with inflation, with an expenditure amount to cover costs and cover their grant making. And so I think this is a far more honest comparative. It's more difficult for me to try and meet because it will always be positive, whereas markets will go through weak periods. And then also ARC, this is Asset Risk Consultants. It's the independent organizer that collates real world charity investment performance from ourselves and 35 of our competitors and presents that. So we can see that over 1 year, okay, with rounding, it's probably not much in it at all. And this is net of fees, so after fees being taken off. Over 3 years, ahead again. 5-year figure, we've dipped not far off ARC. This was a period then in 2022 that I just mentioned. Inflation spiked to a 41-year high. Markets were weak because of all that was going on. And so that was really a really difficult period. So that's captured in that 5-year period. So 2022 was a weak one for us. Then we start to move further afield. You can see that's 50% against 40% of our peer group. And over 10 years, 112, 113% against 83% of our peer group. And so other than that peculiar spike in inflation in 2022, then actually performed very well against both benchmarks over most time periods. And the last thing really I was going to mention was just about what I tend to focus on is that middle column and the bottom half of that middle column of companies, because, yep, Councillor Shaw, you mentioned about AI. So Tetra Tech is a consulting business. They consult mostly on kind of water use and things like that. But it has been a bit weaker because of concerns about the federal budget and often defence budgets, and also withdrawal from environmental policies. And so it has been weaker, but we still quite like the company. A bit nervous about what's going on in the US, but that's one of those ones we are watching. Accenture, great company. It provides a lot of consulting about the use of technology within the workplace, how to best use cloud-based storage, how best to use artificial intelligence. And although it's been weak here, it's actually, since we added to the portfolio, it's up 105%, so doing very well. Eli Lilly, pharmaceutical business, fantastic product line. The GLP-1s, the weight loss drugs, they've got a couple of drugs there, diabetes and weight loss, but kind of crossover there. Again, a little bit weak, but it's up 84% since added to the portfolio. So it's done very well. It's not unusual for companies when they perform really strongly to go through a bit of a period where people just take profits, exactly as I was saying that I was doing for yourselves. Take a bit of profit, maybe it dips a bit, and then hopefully it continues to rally after that. I'll go into Ørsted next. That's the Danish national oil and natural gas company. It's the largest owner and operator of wind farms in the world. We sold out of that. It's no longer in the portfolio. Really like the company, but it's just at a torrid time. They had all these contracts. They had basically had the lease for parts of the seabed off the east coast of America. And of course, with President Trump coming in, he's just sort of said, no, we're not going to have any more wind farms put in place. And so these contracts they had became worthless. They had to write them off. I think it's just shy of $2 billion of value they'd write off. So that's now sold. Owens Corning is one which we're reviewing. It's a US mid cap, so it's not a huge company. It's not a small company. Somewhere between, in theory, I really quite like it. They're a house building supplier. So largely roofing, insulation, and doors are the three key products. But with the tariffs on timber coming from Canada, other tariffs of products coming from other parts of the world, it's really punished them. Traditionally, Owens Corning, one of the things we like about it is that they specialize in doing post-storm damage repair materials. And so, of course, if the hurricane season rips the roof off your house, then you're not going to sort of sit there without a roof for 6 or 12 months. So we believed it was going to be more stable than traditional house builders. It has had a really difficult time, so that's one of the ones we're reviewing, and we may reluctantly sell it because it just feels like the case in America just isn't supportive for it just now. That's that next slide is just really about kind of looking back over your what you wish the portfolio to achieve, but we reviewed that actually quite recently, so I wasn't going to go over those. But I'll stop sharing just now and just hand back to see if there are any questions.
Thanks very much, Gail. Anyone have any questions, comments for Gail? An easy time today. Okay, thanks very much, folks. Next item on the agenda is the review of the investment policy statement, which I think we've got to do annually. Is that right, Christine? Yeah.
Yeah, that's right. Sorry, my voice isn't great this morning, Chair, so I'll ask Jeff just to come in.
Were you at the game last night, Christine?
I was not, but I did get a little excited at the end.
Okay.
Thanks,
Jeff.
Christine. Yes, that's just the annual update of the investment policy statement for both funds. There weren't any administrative changes required this year, changes in jargon or legislation, and we did review the income targets last year, so we're just recommending that they stay the same for this year, just to probably try and capture long-term trends rather than the fluctuations within the year. I think you could have picked one quarter this year, it would indicate an increase, and another quarter a decrease, so we're just sort of recommending to keep them the same, as well as the benchmarks as well. We adjusted them last year in line with the sort of portfolio, and we don't feel the need to change that this year. So we're actually recommending that both policy statements stay the same from last year, but happy if there's any discussion or any comments, and we can to make for any changes.
Okay, thanks, Jeff. Any questions, comments? Are we okay to agree the recommendations? Okay, that's agreed. And that's us. Date of next meeting is the 10th of June. We'll see you then. Thanks, folks.
Thanks.
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 Take care.
Thanks. Bye-bye.